Kyle Floyd. I'm the CEO of VOX Royalty Corp. We are a precious metal focused third-party royalty acquisition company. What we look for is great royalties all around the world that entitle us to a revenue interest in these projects.
The best performing royalty company of 2021, according to us. And the numbers. How are you doing? It's been a while. You've been okay? How's Christmas?
Matt, it has been a while. Christmas was great. New Year's was great. Happy New Year to you and the team. It was a really successful 2021 for us. So it was great to kind of turn the page and get into 2022 as well, because I think this year is likely to be our best year yet.
Well, strong start. Sibanye Stillwater project. You just picked up a royalty there. Tell us a little bit about that, because I want to get into that one, because it's potentially quite a big deal. So why don't you give us the highlights first?
Yeah, this deal has been brewing for a very long time for us. It's something that our team is really excited about. Our shareholders are going to be really excited about. And this is, when we talk about being able to find great assets and great royalties at great valuation for our shareholders, and finding a way to put these types of interesting deals together that really create value within our business, this exemplifies all of that. And so this is a deal, in our database. It's really one of those forgotten royalties. It is a absolute elephant. It's a monster. It increases our gold equivalent ounces under resource inventory and royalty linked by magnitudes. It's a 50 million ounce all in gold equivalent resource. So we're talking about just an epic project of significant proportions. Previous producer as of 2008, and operated by one of the premier mining companies on the planet, and a mining company that really knows how to operate these types of deposits. So kind of checks all the boxes for us and what we're looking to create, and where we find value for our shareholders.
It does as described, but I want to get into it, okay? Because it's a $10.4 million deal, Canadian. What was the structure of the deal? You're not paying all of that up front, obviously.
Correct. So it's $1.5 million in VOX stock upfront, and that is restricted for 2 years. And we've been very consistent in our messaging to the market that we are not looking to dilute via an equity raise anytime soon. We are continuing to find ways to stretch our balance sheet in what we would call the most attractive ways possible. This being one of them, where the group that sold us this royalty really took a long-term perspective on our stock and on the upside. And our ability to create value for shareholders. They were also able to take some risk off the table. This is in Sibanye's 2 to 5 year development horizon, as they've disclosed. So for them, it was taking a little bit of risk off the table, but more so that upside in our stock, and realizing that our stock was also going to move and have that potential for really significant increase in relation to bringing this deal in.
Okay, so there's two projects: a Dwalcott project and also the Messina project, 1% and 0.7404, I think, if I remember correctly. You're talking about 50 million ounce gold equivalent. That's massive. Do your royalties sit on the entire 50 million ounce, or part of? Start with that.
Yeah, so our royalties sit over the entirety of the known resource. Which is obviously very, very significant. And so to break it down a little bit, the Baobab shaft, which goes down 450 meters, tens of millions of dollars were spent on this back in the early 2000s to bring this in production. It went out of production because platinum cratered. It went from around $2,000 an ounce to around $200 an ounce. So it's a platinum, palladium, rhodium deposit mainly, and then gold and nickel. So it's a really interesting deposit type. But if you look at that basket of metals, since the time that went out of production, there was a little bit of volatility. They're reskinning the project and commencing, and they've already completed 2 studies since 2017 on it. But that basket of metal prices has increased on average about 7x from where it was when they kind of paused and went in care and maintenance on this project in 2008, 2009. So it's one of the things that we really looked at is the viability of this project. Was there. It had tens of millions of dollars spent on development, is now kind of making those noises. This is coming back. And when you're talking about 50 million ounces of gold equivalent resource on a past producer operated by one of the who's who of the majors on this planet for operating these types of deposits, to us, this is just a fantastic deal, pretty much from any vantage point.
Right. And it's a gross royalty. Just remind people, not a net royalty. It's a gross royalty.
Correct.
So just coming back to the money side, 10.4, 1.5 of that in shares locked up for 2 years is the start. Where's the balance come from? What are the deliverables that they need?
So the balance really will, and we'll get into this in more detail on kind of the further closing press release, but it really comes down to meaningful production milestones being hit on the project. So, we're really in a very low risk position right now, where if for whatever reason there's delays, we're not in a big stock outlay or cash outlay position, but we fully expect that 10.4 million will be paid at some stage. We believe that this project is going to come back online, and we're really excited about that. So really amazing value, really good kind of risk appropriate opportunity for us that obviously increases our metal inventory in the ground by magnitudes.
But let me be clear. I want to be really clear here. So there's no outlay from you until to what point? Because obviously there's a 2017 feasibility study. They reviewed that in 2020, and a conceptual level reopening studies happened already. So they sound like they're committed. And they're a big company, a big balance sheet, able to get cheap capital to get things moving. But they've also got lots of other projects around the world. How sure are we that this thing is, a priority for them and it will get into production? And if so, talk me about your need to deliver further payments to them at what stages? I'm kind of interested in the detail here.
Yeah, again, we will be delivering. There's another kind of smaller payment that will be due when production is commenced and royalty revenue is received. And then there's a much larger payment that gets you to the 10.4 when millions upon millions of dollars have been realized in royalty revs. So really for us, I would say in the next 12 to 18 months, not much exposure for VOX shareholders in terms of more shares, significantly more shares going out. So we believe it's a very well struck deal in terms of how it's been organized in terms of compensation for the opportunity. And I think also well done for the seller in that it takes a little bit of risk off the table, and they maintain a lot of exposure obviously to this project and believe in what we're building here at VOX. So that's what that looks like. In terms of Sibanye Stillwater's kind of attentiveness on this project, they've had disclosure out to the markets. It's in their active 2 to 5 year plan. You look at the infrastructure that's been invested, you look at the metal price movement, 7x for this basket of metals from where it was in 2008. And then again, they are making kind of this kind of transition and investing more dollars into what they're calling more of the clean tech metal space, nickel being one of those metals. Nickel's a huge byproduct on this opportunity in this project. So when we looked at it, it checked all the boxes that we could possibly be looking to check.
Right. And like, obviously we look back at Lonmin's production, 73.5 thousand ounces of PGMs, and, I think it was 752 ton of nickel and 513 ton of copper. So, it produces a certain rate. Are we expected to use those figures? Did the feasibility study which they put out operate at that level, or are they planning to increase? I mean, what's the sort of ramp up? Is there any indication? When can we start doing some math here and working out what the potential is for you?
Yeah. So if you look at what it produced and what the feasibility study says, that would do around $1.3 million worth of cash flow per annum for decades. If you look at some of the feasibility studies and the updates to it and what you could kind of reasonably expect, if they bring, so the Baobab shaft already sunk to 450 meters, it's already produced, and this royalty is paid. So, it checks a lot of boxes in terms of the security of the interest. If you look at the dwell crop, which is, again, the mineralization and the veining kind of moves continuously across the land package. So this is kind of that next grouping of high-grade veins. If that project comes online and they are going to be driving into these ore bodies, it's our understanding that this is going to form part of the bringing back into production plan. That would see, on a high-level basis, revenue approaching $3 million. At pretty conservative metal prices. So that's kind of to get your head around some round numbers, 1.3 to about $3 million annualized revenue for decades. I think a lot of room for upside on those numbers as this project advances with continued studies and further investment by Sibanye Stillwater.
It's vast. 50 million ounce gold equivalent is vast. decades. I mean, how does a company like you, or how do royalty companies generally play this? Obviously, $1.5-3 million a year is welcome, but you could offload this for a big chunk of change, couldn't you? Wouldn't someone else give you a nice big multiple on this one? You've done a great deal. Further down the line, can you monetize it further for more immediate return?
I think it really comes down, Matt, to what our shareholders want. And if our shareholders said, look, value extract on this opportunity, sell it on to somebody, we would. What I will tell you is the pretty clear messaging from our shareholders is that this is exactly why they're invested in us. Go find great value right where you stand now with catalysts ahead. They're going to significantly increase the valuation of this company. We've been tremendously successful at doing that for the last few years for our shareholders. This is consistent with that strategy of disciplined acquisitions, finding forgotten royalties. I mean, this was a royalty originally held by a company. The project was originally held by a company called Sibanye, was then acquired by Lonmin, was then acquired by Sibanye, which acquired Stillwater. These are the things that we're looking for around the globe, activated by our database, activated by our people. Rian Easterhuizen did a tremendous job bringing this deal in. He's South African by birth, spent a lot of time on the ground there, has great relationships. So it really takes all of that to bring these deals to the table. That being said, if it was in the best interest of our shareholders to go find a way to monetize it, we would. But I don't think that's the messaging from our shareholders to us as management and our board at this stage.
Okay, so if I'm looking at what some of your peers are doing, we interviewed one of your peers a few weeks ago, maybe a bit longer. They're 4 times your market cap, 5 million revenue next year. Compared to you, they seem really well valued. I mean, are they doing something right? Are they doing something better than you?
Well, you mean more valued compared, higher relative valuation compared to us?
Yeah.
Look, I'll probably leave it to you and to the rest of the investors out there to make those comparisons. I think we're executing at an extremely high level. The value that we're bringing in, the ability for us, because we've looked at so many transactions, we're scouring the world. We have a great team. They're technical by nature. We've just created a lot of value by being very, very disciplined. I think the market, this opportunity being one of them, is going to wake up to how much value we're able to create on a systematic basis. A lot of this royalty kind of, I would call it the sector, is based around paying top dollar for deals and trying to scale and eventually get to the $1 billion size, and then tell investors that they're going to realize a re-rate when all they've done is serially overpaid for acquisitions. I think it would be very hard pressed for even any of our competitors out there to say VOX is overpaying for what they're doing. They might have different niches and slightly different styles in terms of what they're trying to achieve, but ultimately, no royalty company out there has a competitive advantage that we do, and they're not able to utilize that to the extent that we are. So I think our systematic capabilities are proving out, and the investors that were listening to us when we went public may have had some doubts on our ability to execute. I think we're answering a lot of those doubts, and have demonstrated and validated that we can create more value than just about any other royalty company in the sector.
There's not one interview that I've done with a CEO of a royalty company where they've said we've overpaid. They've actually all said we have bought really, really well. So you've just said what everyone else says, but what's the difference between you and the others? You don't need to name anyone, but I'm just saying when you say, and you're using strong language there, saying we're buying well. No one can criticize us because we're being highly efficient. We're doing all the right things. We've got stuff that other people haven't, but it's a bit difficult for investors out there when everyone's saying the same thing. So show me what I should be looking at. Talk to me about what I should be looking at.
Absolutely. And it is tremendously difficult. And some of the royalty companies are doing their best to make it difficult on investors, to be honest with you. And the reality is, if what you should be looking for as an investor is, what's your price to book? Ultimately, you should be buying assets and returning a multiple on that to
price
investors.
To book. You're using terminology there that most people don't understand. Price to book means what?
Okay. Price, so market value of your company over how much have you paid for your assets. So that's a very good metric to start with, because if you put out $180 million for deals, acquiring royalties or streams, and you traded $180 million, they've essentially done nothing with your capital in terms of adding value to it. So that's a really good place to start. And we lead the industry in that capacity. The other place to look is revenue. Well, how much have you paid for that revenue? And this is where it gets really interesting. If you look at a lot of the companies that have come to market over, say, the last 5 or 6 years, their gross margin, or really their net margin, their net profit on those deals. So if you take what they're realizing revenue, less what they paid for it and the depreciation therewith, their gross margin on these deals is very, very thin. So, they're paying 1 times NAV. So they're paying full price for an asset. 1 times NAV means 1 times the net present value of that cash flow stream. Well, what have you done for your shareholders? If you bought something at 1 times NAV, you are relying 100% on an arbitrage multiple, which says that because it's in your portfolio and we're going to try and find some upside and belief in your business and that this royalty might be worth more at the end of the day. And it gets down to the royalty framework and some of the advantages of royalties that don't exist in all royalties. You're going to buy it at 1 and hope you trade at 1.5 or 2 times net asset value. What we're doing fundamentally is we're buying assets at a fraction of their net asset value and then allowing them to re-rate within our portfolio. So when you look at what we delivered in 2021, we had the highest rate of revenue growth organically. So assets acquired pre-revenue that turned on revenue. And when they did turn on revenue, those gross margins were extremely high. So even accumulating or accounting for depletion of those ore bodies, our gross margin was extremely high. Most royalty companies are not delivering that for their shareholders. They're paying such a huge premium upfront that when you start depreciating that ore body against the revenue that they're bringing in, it becomes basically a cash flow wash situation.
Okay.
Sorry if I made that too complex, but we could break it down more.
We'll break it down. In fact, we will break that down for people. Don't want to go over old ground here. If I look back at 2020, this is a good deal. I mean, we've looked at this. I haven't had much time to look at it, but from what we can see, this is a strong deal. From what you say, this is a strong deal, and like for a multi-decade basis, it's a good deal. Last year, what was your best deal last year?
A lot. I mean, I liked all of our deals that we did last year.
Sure, but come on, who's your favorite child?
Probably the one that I was most excited about was the acquisition of the Janet Ivy producing gold royalty. We bought that for a fraction of net asset value. It delivered just as we thought it would, where we bought it right before, it basically became very, very clear that the operator Norton, who's owned by Zijin, was going to be investing hundreds of millions of dollars to make that the largest heap leach gold operation in all of Australia. So that's in the middle of a huge ramp up. So that would probably be the one that I was most excited about. But again, there were a lot of acquisitions last year. I believe we led the space and acquisitions. Again, we don't talk about growth for the sake of growth. It's growth at really, really good value on great projects. And, we continue to execute.
Right. And when are we able to talk to you about you? We saw obviously the third quarter numbers come out in November. Fourth quarter will come out when?
Fourth quarter, I think we're targeting April.
Okay. A little bit more of a roundup there. Are you expecting to finish the year with net income, or in fact, just talk to me broadly?
I can't speak to that yet. We'll see. I think third quarter we were basically. I think if you looked at the trailing 9 months from third quarter, if I'm recalling correctly, we were right around plus or minus a penny or two. So I can't really speak to fourth quarter right now, but. What I will say is, profitability is probably not the ultimate metric that we're targeting at this stage. I think over the next probably 18 to 24 months, companies, I've been asked this by investors, how should we be thinking about profitability? Ultimately, companies are valued based on their profitability, right? So that is a metric for us that, we'll continue to be paying close attention to and starting to guide to. But, right now I look at operating cash flow probably a little bit more than I look at ultimately net income.
Right. And how many more of these conversations are you in, like the Sibanye one?
I can't get into great specific or fine detail on this, but I think we're off to a red hot start to this year with what we have brewing. So really excited for what's to come and what we'll be able to talk about over the coming weeks and months.
Brilliant. Carl, good to catch up with you. Well done last year. Well done on this deal particularly. We'll see you soon.
Thanks, Matt. Appreciate it.